Good afternoon, everyone, and welcome to another in a long series of TradeStation's Spotlight On webinar presentations. Spotlight On is a very unique webinar series that introduces you to professional traders and educators who will offer their distinctive insights and methodologies on a wide variety of markets and trading topics. My name is Don Prattle. I'm the Director of Trader Development here at TradeStation, and today we put the spotlight on Ken Calhoun, the President of TradeMastery.com. He'll discuss some swing trading strategies with TradeStation for us today, and Ken will show us how to trade the strongest stock swing trading breakout patterns. I'll let him explain that in more clear detail. You'll learn practical step-by-step patterns to use when trading breakouts with candle charts and how to find and manage your trade entries from start to finish. The webinar is being recorded. That's a great question. I knew I would see it soon. Let's go through the disclaimers and I'll get out of the way and let Ken do his work. The following presentation is for educational purposes only. All of the symbols and trading ideas that we are going to discuss here are for demonstrational purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind, any place, where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everybody. Options trading does carry a high degree of risk and is not suitable for all traders. Please take a look at the disclosure information in the PDF handout that I've posted in the chat panel that contains the risks of standardized options. And also other important disclaimers, in addition to a third PDF that holds all of the upcoming webcasts that we have planned for the next month or so. So I really urge you to take a look at our upcoming Spotlight On webcasts. These are free interactive webcasts. We've got a lot of new speakers coming on board and different topics monthly. Exclusive promotional offers often accompany our webcasts. So visit the live webcast section of TradeStation.com to register. So that gets us to Ken Calhoun, the President of TradeMastery.com, as he discusses swing trading strategies with TradeStation. Ken, take her away.
All right, and thanks so much, Don, and thanks to all of you for being here today. We've got a really big turnout and a lot of exciting current live chart patterns to work with in today's markets. Just wanted to make sure that everybody is seeing my screen share for today's presentation. Don, is that correct? As opposed to the internal.
They should see.
There we go. Hey traders, can y'all see this chart okay? Full screen for EXAS, Exact Sciences. Just want to make sure everybody can see the charts fine. All right, well, let's get on with it then. Hey, it's a real honor to be working with TradeStation, an outstanding charting platform. I know a lot of my traders at Trade Mastery and Day Trading University use TradeStation. We're going to get underway right now. Today we're going to look at swing trading success strategies. I've traded millions of dollars worth of real money trades, and one of the things that I want to share with you is the difference between the strongest of the swing trading, and I'll define swing trading as being anywhere from overnight holds to up to a couple, 3 weeks for stocks, usually in the $10 to $50 a share range, and ETFs. We're going to be looking at some outstanding charts today. I have virtually no PowerPoint slides. It's all on current market TradeStation charts. We're going to take a look at those in just a minute. But first, just a disclaimer, all information is for educational use only. I'm not making any advice about what to buy, sell, or hold. By watching this, you agree not to make actual trades. It's all for learning the patterns. You may have seen me in theStreet.com, Stocks and Commodities, Active Trader Magazine, Equities.com. This is Featured Speaker Money Show, CBS Market Watch, and the rest of it. Been all over the place. And what you guys want to learn are some good high velocity breakout patterns. And so what I want to cover today is gap continuations and candlestick breakouts and the differences between the very strongest chart patterns and everything else out there. I'm not going to read through all these. Just briefly, we're going to look at the best moving swing trading charts, how to avoid false breakouts. Many of you may have been troubled with getting into a trade that goes against you right after you get in. And if, like me, you've done that a few thousand times and you get frustrated and it costs you a lot of money, you realize, stop the madness. There's got to be a better way. So what we like to do is use what I call a false breakout filter. For swing trades, that's usually 50 cents or so above the nearest whole number high breakout. How to do that with the charts we're going to be looking at momentarily. Also, I want to teach you how to use TradeStation charts to find the very strongest visual scanning entry patterns. I'm a big fan of keep it simple. I'm a huge fan of just looking at price action, naked charts with volume. That's all I care about. I care about making money. And the way I do that is I don't have what my colleague Tony would call the chart spaghetti. I don't put all kinds of derivative technicals on the charts. That's not what it takes to make it as a trader. What it takes is good risk management and good strong chart patterns. We're going to be looking at the very finest of the breakout charts in today's markets and how to set entries for gap continuations and multi-day breakout charts. So with that, let's go ahead and take it away and start taking a look at today's charts. Our first chart today up, and I'm going to go through all of these for you and give you some kind of an encyclopedia visual chart patterns of the very strongest charts in today's markets. What I would say, the two biggest mistakes that traders have made, and I've trained thousands of traders over the last 17 years, is that they use stop losses that are too big or they trade without stops. And the second problem is that y'all trade choppy charts, whether that's the cheap pop and drop penny stocks or $3 or $4 or $5 stocks that don't continue, or charts that don't have sufficient range. The first concept, the rider downer, is make sure that your swing trading charts of at least a couple weeks duration have a minimum 10% price action range. So a $13 stock that goes to $18 like this one is ideal because we got 5 points of range in this. A $12 stock that goes to $13, not so much. My favorite chart pattern is institutional buying on gaps, or in candlestick parlance we'd call these windows, for continuation plays. So EXAS did a nice gap up today. I'll be interested in buying this if it gets over, say, 1880, maybe over 19. Okay, I like to get things at least 30 to 50 cents above the current high before I go long. It's usually, by the way, not a good idea to trade the day after a gap. So I'm not going to be trading in this chart tomorrow, but I may put on a small pilot trade or a test trade Wednesday or Thursday if it gets over 1880. That'll be my trigger point. And by the way, if you have any questions, feel free to ask them. I look forward to the questions as one of my most favorite parts of this because I know what I'm going to say, but I don't know what you guys need from me, so let me know any questions. I've traded so many thousands of gaps over the years, and one of the best things to look for are gap continuations to buy new highs. Now, a rockstar chart today was 3D, and one of the things that I want you to focus your energy on as a professional trader or a professional in training, as the case may be, is look for outlier charts. These are charts that have heat, or they're in play, as my Wall Street, as institutional clients would say. They've got chart patterns that have exceptional volume and volatility. As a professional trader, it's my goal to make as much money as I can, as easily as I can, while sacrificing as little in stop losses as possible. For swing trades, risk management is always, job number one. I use no more than a 2-day low or a 2-point maximum initial stop. So if I buy this up at, say, 17 and a quarter, 17.50 later in this week, I'm not going to let it go any further down than, say, 16.50 against me if it does a false breakout. If it keeps running up, then I will scale into it, say, over 20, or I will add to a winning trade over 20. That's another quick point, is it's very vitally important that every single trade you put on should not be a holy grail indicator, hey, it's running, let me jump on board with the huge 500 or 1,000 share trade and hope for the best. That's gambling. A professional trader's approach is to trade a basket of a small portfolio of, say, 5, 8, 10 different stocks. I may be in as many as 15 or 18 positions simultaneously, but I will never just do a single stock trade because some magic indicator is telling me it's a breakout. Now here we've got a classic cup pattern. We just deconstruct this chart for you. The main thing about this chart is we got a lot of volume on a breakout today, around 1450 to 1670 or so. So that's a nice 2.5 or just almost 2.5 point run. So I'm definitely interested in 3D once it takes out new highs in a subsequent trading day later this week. A quick note, following a gap or a wide range breakout day, you will often find a resting day, or even, you may have seen my articles in Stocks and Commodities on a mean reversion, which means this may just pull back down to 50% and then bounce. We don't want to do that, or we don't want to engage with it unless it takes out new highs. High volume breakouts following cup patterns is what I specialize in. You'll often find a large green momentum candle at the right side of a congestion box or at the right side of a cup pattern. A cup is simply looks like the letter U, or a coffee cup. I drink lots of coffee. Coffee is a trader's friend. This is also an ascending triangle. If you were to mark this out, it's an ascending triangle pattern that forms the right side of a bullish cup. That's all well and fine. We want to know how to trade it. Well, unless we can get in a time machine and go back to early today, this morning, we're not going to be able to wind time back and buy it at 15 or something. So the next best thing is, how do we trade the great unexplored right side of the chart over here? And whether I go short on a day trade on a loss of support under 1650, or I buy a new breakout over 1750 for a swing trade, this is a chart that's absolutely positively worth trading coming up in the next week or two ahead, because institutional traders vote with volume and price action. Notice, please, the complete lack of things like RSI, stochastic, MACD, all the derivative technicals. I used to be a statistician for the Ford Motor Company in Dearborn, Michigan. I also worked for McDonnell Douglas and Rockwell International and other big companies. And one of the things I found in data points is all you should care about as a trader is, number one, keeping small stops when you're wrong, number two, trading the strongest charts, and number three, using tight stops. So strong charts with tight stops is critical. So this is another rider downer. Look for wide range candles, tall, big green candles that are significantly, say 2 or 3 times the average height of prior candles, occurring at the right side of a bullish cup or gap continuation to tell you it's worth taking a shot at up at new highs. And even if we missed it, I missed this one today. I wasn't trading this one today, but we still have a good chance to trade it on a continuation up at new highs. Let's move on. Here's another good one. UCTT. This is ultra clean holdings. UCTT gapped up 1040 to 11 and a quarter. Another large green candle led to new institutional high volume breakout buying today. This goes on my watch list for a play. Now, one place, oftentimes you may ask yourself, how do I find these kind of charts? You can develop, one thing I did is I put together my own TradeStation rules-based scanner. I didn't find any symbols that hit the criteria today, but you can put together your own scanners that identify things like multi-day high breakouts or good volume breakouts. You can also look for things like 52-week highs or other volatility sorts that tell you good candidates that may make sense for you to put on a swing trade in. So as you take a look, good question from Gene, how to identify a good gap from a bad one. The main rule of thumb is no more than 10% up. Okay, no more than 10% or so, especially for the higher priced ones. So if it's a $10 stock, if it gaps up a point or two and gets new buyers, fine. But if it gaps up 5 or 6 points, I'm not going to trade it because that may do a gap fill or gap reversal. So 10%, up to 10% or so. So for a $10 stock, up a point or so. A $20 stock if it gaps up to 2 points. A $40 stock if it gaps no more than 4 points and gets new buyers. The other thing to look at, and it's a good question from Gene, is really important, is look at the reaction of the buying community at 9:30 to that gap. Do they sell it down or do additional buyers come in? And you can often find a volume confirmation. Like everybody see this tall green volume candle down, or volume bar down here at the bottom that accompanies this tall green candle today on the open. So that led to a nice uptrend continuation in this gap. And what I want to hope to accomplish with you today is to give you kind of a look over my shoulder at some of the very best chart patterns that are professional swing trader trades, what I trade. What you don't want to do is trade stupid cheap charts like these kids who are telling you to trade penny stocks or this junk stocks. Like let's pick on this one, MACK. Now, who can tell me what's wrong with this chart pattern? I mean, maybe you got a short shares available off and got a short, But oftentimes these have no trend and they're not worth trading. So although the volume is fine and the volatility is there, the trend is not. So for that reason, I'm out. I don't know how many of you like popular TV shows that say things like, stop the madness. For that reason, I'm out. Instead, we like gap continuations and instruments that have superior price action. So remember, one of the key things that I want you to remember for the rest of your life as a trader, you have my word, this is absolutely valuable. Make sure that there's a minimum 10% price action range on a, say, a 2-week swing trading chart. So $40 stock, the 41, it has to go to at least what? 45, at least a 4-point delta or change. This has double that. This has 20% volatility in Clovis Oncology, which got a nice gap continuation runner today. So it's a good question from Gene. This would be a great gap. It's a minor gap, less than a point or so above the previous day's high, and it ran on up 4 points today. We got some tweezer top shooting star up here, so we don't want to go long right now kind of thing. But if it continues on up over, say, 51.50, I'll likely go long because that's 50 cents above the whole number high. Look at this range, 41 to 51. It's got 10 points of range. Even if you only get a third or half of that, still 3 to 5 points on a breakout. It woke up today, and now it's up at new highs. So for that reason, I'm in if it continues up. Here's another good gapper from today. Global Payments, GPN. A little pricey. I like to keep most of what I trade under 50 bucks a share, but this is a good example of what I call an acceleration ramp. And you may have seen me speak on this at the Money Show expos and whatnot. You have a steady uptrend, kind of like a congestion area, steady uptrend for a couple of days. It then gets to be a sharper angle, 45-degree angle breakout trend, which is great. And then it led to a nice gap up, right? And this gap from 74.50 and 74 up to 79. So it's got a 5-point gap. It's less than 10%, and for that reason, it kept running up today. It did a mean reversion. It ran up, pulled back to 50%, and bounced. That 1, 2, 3 pattern is often seen, right? Here you can see off its lows. It moved up, pulled back down to half, and then continued its uptrend. Like this. It moved up, pulled back, continued. Moved up, pulled back, and continued. So that's on the radar. Another good rockstar breakout chart is ACHC. Your biggest challenge as a trader is, and again, I've worked with thousands of traders both in person in my public appearances and my seminars the last 17 years, plus on the internet with thousands of live webinars, and what I found is most traders ask about charts that you're kind of doomed to failure with, or they'll ask about choppy charts that the odds are really bad of trading in the first place. You want to kind of play with a loaded deck, you know, kind of like I play in Hold'em tournaments in Vegas a lot, and it makes life a lot easier if I've got pocket kings or pocket jacks or ace king or aces than if I got a 7-deuce offsuit. And same thing in your trading. You want to start off with the very finest sustainable trend breakouts that you can. One of the common misconceptions is that you can make a fortune trading the penny pump and dump stocks, that like a $1.20 stock that runs to $1.50 and then pulls back. Nothing could be further from the truth, because you've got to over leverage and trade 1,000+ shares and absorb a huge amount of risk. As a swing trader, I would rather take shots at, you know, any 5 of these or any 10 of these with a small pilot trade, maybe 50, 100 shares at 50 cents above the new high for breakout entries, and manage that portfolio of instruments professionally. So I will feed the winners and starve the losers. I'll scale in every couple of points. Let me ask a quick question. Whenever I ask this in my public appearances, I had a standing room only crowd back in Vegas in November, over 100 people in the room. I asked, how many of you, show of hands, and I'm going to ask y'all right now, type in the letter Y if you always add to your winning trades, or have at least as an underlying goal to position size or scale in or leverage in, build a trade, like Build-A-Bear, but instead of a stuffed animal, you're building money in your account. So if I buy 38.50, it's not because I think this thing's going to run to the moon and I'm going to become a next bajillionaire trader, $1 million. Just say no. It's because I've got in the back of my mind, I want to add to it at 40.5. And that's where I'm going to make my money. It's not these initial pilot trades. Okay. And these are breakout charts, Bob. So I've got both gaps and breakouts today. So most of you saying no. We got a few no's. We got a yes. Hey, Jessica, good for you. Every trade you put on, traders, and this, it took me so many years to learn this. I've been trading, you know, I've traded millions of dollars worth of stocks and ETFs and FX and minis and all that over the years, mostly stocks. second place ETFs. And what I found was you absolutely have to have in the back of your mind, every trade is just like a little seed that you're planting in a garden. And half of them are going to die and not go anywhere, or 2/3 of them are going to die and not go anywhere. So how do you still, gain a harvest from a small handful of seeds? And it's always by adding water and nutrients to the ones that are starting to sprout. And it's kind of a good visual analogy. Not that I would ever have patience enough to garden, but the point is you always want to feed your winners. So if I buy this at $38.50, that's not it. It used to be that would be it. I do like 300 shares at $38.50 and hope for the best. And then maybe it drops against me and I take a big stop and I get frustrated. And then ultimately it keeps running up to 45 without me. Then I get really ticked off. So what I found out, the smarter way to trade is to trade 5, 6, 7, 10 instruments, small size on the front end, and then add to only those that run up at least a couple of points from your entry. It's kind of a 1-2 punch approach for professional swing trades. Does that make sense? The first trade I would buy in this, again, not a trade recommendation, but at least what I'm going to do, $38.50 would be my first trade, with the thinking that the real trade is kind of like a pilot trade, a baby trade, maybe 50 shares at $38.50. You can use this for directional options trades too, but I scale in at say over 40.5, and that's the real trade. And what the thing is, with 5 or 7 or 8 trade entries, that I buy a new highs, maybe half of them stall or they don't go anywhere, or they reverse back course, and so I take really small stops, and that limits my exposure on the front end. The most important skill to get right as a trader is professional risk management, and make sure that when you're wrong small. So I don't use major support way down here. I use at maximum 2 points initial stop, or a 2-day loss of support. Here's another good chart. Under Armour, makers of fine clothing and everything. It's when I work out at the gym, I got Under Armour gear. Anyway, minor gap continuation yesterday. Got a little bit of love today. Tried to poke its head on up to new highs. It's still in an uptrend. Gaps continue oftentimes, and you will see that another rider down, or a new technique, is make sure that you give preference to charts like this that have multiple gaps. So here, and I've got an article in Stocks and Commodities on that too, multi-gap continuations. Here's one little gap, it ran on up, nice bullish cup. What a nice chart. Okay, gapped up again, ran up again, gapped up a third, gapped down a little, ran down, gapped up again, and continued the madness on up to new highs. So whenever you see a chart that has these stair-stepping multiple small gaps, that tells you the institutional traders are so excited they're kind of tripping over themselves to bid it up, kind of like an eBay auction, and people that don't have any sense, they'll sit there and bid stuff way up, far beyond what it should be priced. Well, as traders, we're looking for new high continuations. So the red candle's a problem now, so again, I'd wait till somewhere north of 28 before buying it. And I'm patient, right? That's the beauty of trading is you can use buy stop orders or buy stop limit orders. So I would personally, I say buy at 28 even, buy stop order 28, limit 28.50. So that way maybe it doesn't hit for a week. But when it does hit, it's overcome the red candle and gotten new buyers. But yeah, that's a smart question. So we don't trade it within this region. We wait for breakout. What I like about it is it ran from 25 to 27.50. So it's got at least a couple of points of price action. You go through these and find exceptionally good ones. Here's another one, Citrip, a CTRP, multi-gap continuations. Okay, now if you've ever been on the wrong side of a gap, you know how frustrating that can be because you're powerless against it. So another tip is don't ever hold into earnings release or major economic reports or whatnot. It's a good idea to go to cash, or mostly to cash, so that you don't sit into a position and have an earnings miss. I don't know how many of you have ever been overnight in an earnings miss that went against you. I remember back in the year 2000, I was long Oracle and I held it overnight, just 300 shares, but it gapped like 8 points down. So I took a bath on that. And so I only have to learn it once. When it cost me a lot of money, I only learn mistakes the hard way once. So don't hold into earnings. But if you do have minor gaps in an uptrend continuation, this thing ran 40 to 43, that makes for a good trade setup. Here's yet another one, FCAU, Fiat Chrysler Autos. Sometimes I miss working for Ford. It's a great company, good management. Anyway, FCAU, a gap up, ultimately continued, gap up again, ultimately continued. Remember, gaps are institutional traders at work. The way that I like to visually look at gaps is or in candlestick parlance would be called a window. I look at it like a window that's been opened, and $100 bills, Benjamins, are floating in for me, right? So think of windows or gaps visually like you're opening the window up, like one of those, the horizontal windows that you open up. You got a bunch of them here in my McMansion here in Colorado. Anyway, you open up the window, and a lot of money flies in the window for you, and it keeps running on up. So not if it's like a 6-point gap, but minor gaps often will continue up like this. One of the biggest hot charts from Friday's session and continued the volatility today is GBX, Greenbrier. And this thing ran all the way from 41 to 47 Friday. Today it did kind of a 2-point range, but this is another good example of volume and volatility keenly at work. You can see a bullish cut breakout. If you just extend a horizontal resistance line here north of 44, we got large green candle, not one, but two, but three. We had 3 large green 1-point candles here, or over 1-point candles. It told you they were so excited about buying it, they couldn't wait to get in. And so this thing ran all the way from 41 to 47, 48. So that's got a 20% trading range in just 2 trading sessions. Now these are a little more volatile and not really for newer traders because the downside, if you buy, say, 48, let's see with that chart, I'd still be okay at 48.50 and 50.50, but if you got into it, it might pull back against you faster than you've got time to respond. So one quick tip that I think can really help your trading is make sure that you match your experience level to the volatility of the chart. So if you've got less than a few years experience, this probably wouldn't be the right chart for you because it's got large downside potential as well as upside. So just because it ran up 7 points in a single day doesn't mean it's going to, or in 2 days doesn't mean it's going to do so again. But this is a really good example of a high volume, high velocity breakout with, again, a minor gap that continued on up. So look for this pairing. This is another good quick visual pattern to memorize. If you see a minor gap, less than a point or two, that's followed by, this is a mean reversion, right? It gapped up, it ran up, it pulled back to 50%, and then skyrocketed on up to new highs. Here's a bullish cut breakout trigger right there. We're about 43.20. So you see a minor gap, that should get your trading appetite worked up. Say, okay, they're starting to buy it up. Where do I get in? And then it's just a matter of managing your entry using easy to observe patterns here, with your charts. Now, simpler charts to trade beyond gaps are just simple 45-degree angle continuous breakouts. Now, this is a nice chart. It's not too extreme. It's not like 40 to 50 or 40 to $60. It's a 42 to 45 range. So it's got just around 2 or 3 points. The reason I thought I would bring this one to your attention, Car Auction Services, is to note a couple of things. One is if a gap does fill, it will often fill back down to previous day's high as support. So you can often get in if you didn't go short on the open, you can get in on a long pivot off of the previous day's high because often it'll find support. Does everyone see how this gap filled? That's the exit target for a day trading short would be the previous day's high. You can also flip to a long to get into it on a pivot, on a bounce up if you got a nice move up, or simply wait for a cut pattern breakout continuation up here. Either way, it's a really good chart because it's got a steady uptrend of at least 45-degree angle run for continuous trading days in a row. So again, my goal in doing today's session is to equip you with the right types of charts that really make sense to trade. My biggest objection to the cheap charts is that they don't have observable trends that go for any length of time. They're kind of one-hit wonders, like playing a video game. It pops and drops. And unless you got off a shot quickly and early for a day trade scalp, it's very difficult to make money trading cheap charts. It's much more intelligent to trade charts that have a nice, well-mannered, continuous uptrend. It's a story of institutional volume coming in and price action, taking out new highs day after winning day after winning day after winning day after winning day. Okay, so this thing ran, what, 25 to 27? About a 2-point range. These are kind of bunny slope charts. A question from Jim, am I buying stock or call options? I trade the underlying. I trade stocks. But you can use this thinking for scanning for options, for those of you who trade options too, for directional options. Good question. Traders asking A from Gene, what's the strategy to enter in the market to keep a stock for overnight? My favorite overnight holds are high volume closes. And smart questions, I like that. Smart crowd here. This is a high volume close, for example, in car today. Notice please the volume is at 2-week highs, right? See this red volume bar right here? High volume, and we're at new high prices. So that's the best, and that's a smart question. I'm glad you asked. It's an intelligent question too. I will often do most of my breakout scanning pre-market, set up my triggers to activate in market, and then come back right before the close to see which ones hit and ran, and if there's any maintenance or trade building work I want to do during the last half hour from say 3:30 to 4 o'clock Eastern. And often if something is taking out new highs on high volume into the close, I will add to the trade as a position sizing idea, because that's a trade that proves me right. A right or downer for professional trading is that good trades are usually right from the start. So it's right from the get-go, the thing, nothing but roses, rainbows and puppy dogs running on up to new highs. We got 44.6 up to 45 and change. We got a high volume close, or HVC. So that's an example of the right kind of chart to hold overnight. Charts that aren't good for overnight holds are ones that are in the middle or at the day's lows. So let's take a look at another chart here. Las Vegas Sands did a gap up today, and notice that same pattern. This gap closed, but it closed right back down to the previous day's high, and that should be your expected outcome for minor gaps that do not continue. If it's a gap that closes, or a gap, kind of a gap and trap, some people call it. If it gaps up and comes back down, it'll often come back down to previous day's high and then start to pivot up to new highs, and that can be a good day trading setup. Or for a swing trade, I just wait for a new high up here. The main thing is this chart qualified to be worthy of consideration for a trade? And the main technical signal you're looking for is price action and volume highs up at new highs. It's something that is likely to attract buyers up if it breaks out to new highs. And that's something I'm always looking at when I'm evaluating trades, just like when I evaluate people for working relationships or colleagues. I look at the integrity and the character and what's the truth of the situation of the person, what's the truth of the situation of the chart. And I look for charts that are likely to attract, like a magnet, like a magnetic money flow type of thing, new buyers up into new highs, because it's got the confidence of all these other people that bought it up, right? You get into trouble when you try and outguess the market. You do well when you trade in trend. I'm a directional trend trader. I'll show you an example of a rare reversal would be dust. We'll look at that in just a second. But first, let's take a look at XIV. This is how I trade the market long. I trade the XIV, the inverse VIX ETN, and you can see it's a triple leverage. It's gone from 47 to 54. A stellar, spectacular 7-point run the last 3-4 days, 5 days. Okay, so a nice gap up continuation, gap up continuous. Inverse head and shoulders, and a gap up and it continued up. This one did a gap down and still continued on up. So I'll look at buying XIV up at new highs, and again 50 cents or so above the price action high is what I use as a rule of thumb for these stocks in the $20 to $50 and ETFs or ETNs in the $20 to $50 share range as a false breakout filter to avoid false breakouts. You should never, ever, 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 ever buy the public money, dumb money breakout right at the resistance area, because that's where they're gunning for you. The market makers and specs. I got institutional clients. They're just waiting for you guys, right? They're just sitting there on the sidelines. Oh, let's see if we can trap them in. And then they sit on the ask and they roll the thing back down, stop you guys out, and then they make the money on the way back up, and you wonder what happened. How come I got snookered by the market? And they're a bunch of professionals out there. So what you got to do is play it safe. Use a safety buffer of at least 30 to 50 cents above the high before you get in. All right. Go back over your last 30 stop losses and see for yourself. You say, oh yeah, he was right. If I'd waited 50 cents above the high, I wouldn't have gotten in. I wouldn't have gotten stopped out. So learn from my mistakes. I've made every mistake in the book and then some. And I learned. It took me a lot of years, but I figured it out for the most part. And the main thing to get right is be in the right ballpark of the right charts that are like this to attract new buyers. The trick is not buying new highs like this. So here's a good example of something that did a false breakout right above resistance. Just enough to get the newbie amateurs in. I use 50 cents above the high, so I would not have taken the trade because 33.50 is up safely out of reach of the false breakout. But newbie traders, does everybody see people are sitting on the sidelines waiting for it to break out to new highs, just enough to sucker in the amateur retailers stop them out, and then it goes sideways, right? So don't be that trader. Don't be that guy. Don't be that lady anymore. Instead, add 50 cents price action trigger above the nearest whole number high before you get in, okay? Now, I like this technical picture. It's got a bullish cup breakout right over 30.5. I like it's an ascending triangle. If I were to mark out trend lines here, you can see the lower bounding box of the triangle would be here, and the upper draw would be 33. But I still add 50 cents before I get in. So I'd buy this up at 33.50, and not a trade recommendation, but at least what I'm looking at, but I'm not going to trade it until then. It's an incredibly empowering feeling as a professional trader to make price come to you. You don't let yourself, like the being tail wags the dog. Don't be that trader. Don't chase, and don't feel helpless because you don't have a specific game plan that has specific metrics and outcomes and goals and parameters and the specific patterns that work out that you've memorized that you can trade. You know, that's what I teach so many thousands of traders, is how to do this the right way. Now, for counter trend entry, let's move on, because we got some more charts here. And then if you have any questions, feel free to ask, because I'm very candid, very open, honest, approachable guy. I tell you straight the truth of the situation, right? That's what my brand and the trust of all the world's thousands of traders, over 30,000 traders, is built on. Is I'm very candid about price action trades, what to do right and what to avoid. So don't trade cheap instruments or derivatives or things that what I call fool's gold. Kind of like going into a casino in Las Vegas and betting it all on 36 or, well, let's say 28 on the roulette wheel, because if you hit it, it pays off 36 to 1. The leverage is a bad thing. You have no business trading a margined account unless you can make money paper trading and small share trading. You know, that's really important too. Don't trade on margin unless you're profitable. That's rule number one for professional trading. Having blown up a couple of trading accounts, it took me years to learn that, so I would save you the heartache. If you've ever, I get a lot of laughs when I do my public speaking, and I say this, if you ever conceal your trading losses from your wife or your husband or your pet chihuahua or whatever, if you ever conceal your trading losses, you might have a problem trading. So instead, do more paper or small size trading, and don't trade margin unless you're profitable, at least in your initial small and paper trades. Anyway, pivot play in dust. This is the inverse gold. This goes up when gold goes down, and vice versa. It's been in a 2-day uptrend, or sort of does. Looks like it's trying to break out. I'm going to buy this over 40.5. I'm going to wait for it to get up here. But dust, I've traded this successfully before. It's on a potential pivot. I'm not going to go long unless it breaks here. If you look at our gold miners, like GDX and Newmont, they've been on fire lately, and they've been doing good, but we're starting to see a little bit of weakness, right? They're starting to trend back down. So for that reason, I'll be looking for gold if it or the dust, the inverse gold instrument, if it starts to pivot north of 40.5, right? So that's kind of my line in the sand. Previous resistance, or previous support is new resistance, and then I add a safety buffer just to be on the right side of things. Good question from Kelly. Kelly wants to know, what's my definition or time frame for a swing trade? Anywhere from overnight up to, say, 2 to 3 weeks. 3 weeks or so, and I start to get antsy. So as long as it keeps running up, I'm in. Okay, I'll use a 2-point trailing stop. So that's the exit side of it, is when price proves me wrong. But as long as it continues to run in my favor, I'm going to stay the course. But my expected outcome is to do my trades, do my business usually within anywhere from 2 or 3 days up to 2 or 3 weeks. That's my preferred time horizon for swing trades. Good question. Now let's take a look at Blackstone, BX, another gap continuation. Now here is like chance number one. It told you it was going to go up. It did a gap up and continued up. But did you listen? No. But if you had listened, it gapped up again, and it gapped up from 28 to 28.50. Ran all the way up to 30.50, so did a 2-point run, and it's been on an uptrend, a slight uptrend ever since. Absolutely, positively worth taking a shot at, up in new highs. I'm going to wait for 31.50, right, to get up over that 50-cent hurdle. But that's a good price action breakout. Notice, please, it has a 10% range, 27 to 31, 4 points of range. So the range and the volatility and the volume all look spectacular. So it's a nice multi-gap continuation runner in Blackstone. Our gold miners, again, gap continuations. GDX, gap up, continuous run. Gap up, continuous run. You know, there's so much misinformation about there. A lot of people say, you go against the direction of the gap. I beg to differ. All my professional clients and myself and all of us who know how to actually trade, we go in the trend of the gap. It goes up, I'm looking where to go long. It gaps up, it doesn't look expensive to me, it looks attractive to me. It tells me it's kind of like the magnet's been turned on and money's going to come into this thing if they get a minor gap that gets new high breakouts. So then I just put on my long trade wherever I get in. Another gap up continues on up. Another gap up goes up. Gap up goes up. Gap down goes down. Gap up, kind of down, then up. Anyway, gaps up are some of the best of the patterns to look for. And especially I've seen this past few months with the market screaming to new highs. It's a great time to be a breakout trader. There's so much profit potential. One of the biggest errors in judgment I think traders have, and it's not your fault, but a lot of people out there in the industry try to make it overly complicated. I think one of the reasons that my appeal has reached so many thousands is because I like to keep things simple, price action and volume based, and chart pattern and candlestick based. So we're looking at the very strongest charts from amidst the universe of thousands of stocks. How do you boil it down to? I did manual scanning for you guys this morning to figure out the best charts. This is the list of the best breakout charts I can find for y'all. And it's a couple of dozen. It's not too many. You may want to pick a few of them and see how they work out in the upcoming week or two ahead. It's a question from Blake on the Blackstone. Would I have taken the trade anywhere in the day of the gap? No, usually I will wait till the day. For a day trade, yes. For day trades, yes. But for swing trades, I usually wait till the day after or even 2 days after the gap. Because often I'm going to miss it. Just to be honest, I'm a busy guy and I'm trading so much. I may be off trading one instrument. In the meantime, something else gapped up and I don't find out about it until that night. And it's kind of, unless I could jump in a time machine and go back in time, I can't trade it. So I'm looking for a trade on the day or two after the gap is a good trade setup. So that's the great thing about swing trading with gap continuations is, and I didn't have to look hard to find these, to be honest. They're all over the place. The main thing is, are you playing the right instruments the right way? This is an inverse head and shoulders, for example. The neckline is right here if I were to draw it. A left shoulder, a head, a right shoulder. What I care about is on the right side of the cup, we have a large momentum green candle. Not one, but two in a row. So you got a couple of shots if you're a day trader telling you it's going up. If you're a swing trader following it along, it also gave you the signal. And it still looks great for a swing trade over, say, 41.5, right up at new highs, up yonder, up here. So if it attracts new buyers, this is a great high volume, high velocity acceleration ramp, as I teach in my money show appearances and my industry articles and thousands of webinars. It's a steady uptrend. If you're to kind of draw a very tight moving average line, it's a steady uptrend here that led to a sharper angle breakout. My hope in going through these charts with all of you is that you understand clearly the types of charts that are worth engaging with. It's like, it's lock and load. We got your 12. Let's see if we can get off the right kind of trades in the right kind of markets and avoid the choppy charts. Now, sometimes, speaking of which, like level 3 and CTL, sometimes they will done the gap, run up, and then start to go sideways. That's still fine to look at for new high breakouts. This I'd buy somewhere north of 26. Right? I use 50 cents over the high, so 26 and a dime. If it doesn't hit that any time in the next week, that's fine. I just sit on it and I trade something else. But these initial gap runners are always the kind of the signal amidst all the noise. For those of you, I used to work at electronics division at the Ford Motor Company in Dearborn, and we have signal to noise ratio and parameters. And if you kind of map out your process flow or make a flow chart of entries and exits, you're looking for decision points. If it runs up, then how do you trade it? And you may trade the new high breakout 50 cents or so above whatever the current high is. Even if it stalls and goes sideways, this is kind of the jump start, kind of like a car back in the day where you had to jump start a car if the battery goes dead. It got a jump start. It's alive. Now we want to trade it, but only if it comes to our price on our terms. The other pivot play, other than dust, that I'm looking to trade is VXX. That's the inverse. It's the exact mirror opposite of XIV. XIV goes up when the stock market goes up. VXX goes up when the stock market goes down, like it was a few days ago. Anyway, now that we're finding a base here, and we got an uptrend off the bases as of today, I'll be looking to go long somewhere north of 22.5 if this takes out new highs because of the upside pivot potential in it. That's a riskier play. Vast majority of what I do is in trend directional breakout continuations. Goldcorp also, like the other minor stocks, Newmont, they all look pretty similar. In GDX. Notice, please, how close GDX looks technically to GG. They're almost identical charts. One of the strategies that you can do from a sector rotation standpoint, and I'm not going to have time to cover that today, but take a look at your sector charts and see if, say, biotechs and pharmaceuticals have been volatile lately, or retailers have been down in the dump, right? If you look at, say, Macy's, it had a bad day and fell off the cliff, right? Or Kohl's. Does anyone still shop at brick and mortar stores? I haven't been to a mall in years. I'm an Amazon kind of guy. Just look at Amazon stock price. That's what I'm talking about. Now, I don't trade $800 stocks. I don't know about y'all. I don't have a $2 million trading account, so I don't trade $800 stocks. But you often see sector divergence. So online retail, Amazon through the roof. Offline brick and mortar retail like Kohl's or Macy's, which are department stores here in the United States, for those of you who are US-based traders, not doing so good. Kind of sort of looks like trouble, like Blockbuster, Circuit City. The end is there, so we don't want to trade that. I like to trade things that are going up. They continuously run up in my favor, that have good, strong breakouts. So I hope that makes sense for the best of the breakout types of charts. Let me click through these one last time and ask me any questions that you have. Let's see, a question from a trader. Kelly's asking, do I also reference weekly charts? No, I don't. I used to back in the early 2000s, but I found these multi-day daily candlestick charts. Look, the 15-minute candlestick charts are good enough because they give me a good directional sense of what's moving up strongly. And as you can see in your TradeStation charts, they do a really good job of illustrating visually the very strongest breakout patterns. You know, like of all the charts that I covered today, that's probably my favorite. DD, and I'm not saying it's going to go up. Maybe the more likely thing is it'll pull back down to 15.5 and then bounce. If I had to lay odds on this, if I was a Vegas odds maker, my odds would be maybe a little gap down tomorrow, maybe drop to 15.5 and ultimately bounce. So we don't go in long yet, but 3D is one of them, and the other was that GBX that ran up 7 points the last couple of days. Those are my two favorite charts in the entire stock market because of the profit potential, because of the range. And again, I'm not over leveraging trading these cheap, stupid $3 stocks like these moron kids are out there trading. Oh, let's trade Mac. Because if I get off a 10,000 share trade, maybe I'll make 10 or 20 cents. Derp. If you don't have much money to trade, it is infinitely, you have my word on this. I'm a real trader, not a trade. It's infinitely smarter. Ask any of my institutional clients. That's how you say any market maker, any prop shop trader, any specialist on the NYSE, they're all going to tell you it's much smarter to even trade 100 shares of a $40 stock than 1,000 shares of a $4 stock, because these things will come back to bite you. So I would completely ignore anybody that says penny stocks are the way to go. The right way to trade are instruments that have great volatility, that are priced, if you trade cheap stocks like this one, what's another good one? For a cheapie, HOV was good, right? If you do trade cheap charts, is that Hovnanian or something like that? On a longer term chart, if you look on a multi-week chart, this thing ran up quite a bit. But overall, stay clear. I've lost the most money as a trader. I would save you my heartache and pain as a trader. That's what my business is built on, is figuring out how not to do it, and then documenting that, and then figuring out how to do it based on real money trades, and then clearly explaining the difference between said outcomes, right? The difference between what works and what doesn't. What works is strongest uptrends, exceptional outlier charts that have a lot of new institutional heat or institutional volume as they continue to do their thing, or it's much easier to trade. You could throw darts at this thing all day long today and you'd have a hard time getting stopped out or losing money, right? So for a swing trade too, for that matter, it's nicely up today. Those are the kind of charts you want to make your bread and butter as a trader, is avoiding false breakouts and using your TradeStation charts to find the very strongest by visually scanning through the different charts. What's most likely, the question that goes through your mind, that goes through my mind, which chart patterns are most likely to attract new buyers up at new highs? And that's going to be something like a good employee that checks out with a good reference check or a good background check. It's got a nice steady history of buying day after day after day after day after day, and then they got all excited and ran up even further today. Those kind of charts are infinitely smarter to trade than choppy, iffy charts or try to outguess the market by using a lot of derivative technical indicators. All that matters is price action and volume. That's all that matters. I don't make money trying to look at derivative, stochastics and RSI and MACD and all that kind of stuff. My biggest money winners are all strongest price action breakouts. Don't overthink it. It doesn't have to be rocket science. You do, though, have to have a sensible, rules-based approach with very tight stops combined with the strongest chart patterns. And gap continuations, as I've trained so many thousands over the years, for things in the $20 to $50 a share range, not $3 stocks, but things that actually run, tend to make the best breakouts. So yeah, to answer Francis's question, do I use any oscillators or similar aids? No. Again, I used to be I'm a certified quality engineer, nationally certified CQE. I got my CQE certification years ago, and a former corporate statistician for the Ford Motor Company. I'm an expert at numbers and charts and manufacturing and production, and I took that expertise. That's why I got good as a trader, is you can figure out patterns of variability or variance in charts. And we want, in a manufacturing environment, you want all the widgets to come out the same. They chart the parameters, it's called a control chart of how big the widget is, like how wide is the piece of sheet metal. You want it to be dead flat, right? You don't have any variation. As traders, we want the exact opposite. We want wildly out of control running things that are going to make us money as traders. And so you want to visually teach yourself as a trader to identify these charts that are most likely to keep running and stay clear of anything that's less than that type of a breakout chart. The best trades that I've made are always those that are continuous breakouts. Never underestimate the power of a continuous trend, either up or down. We've all been on the wrong side of it, right? I mean, at least I have. I don't know about y'all, but I've been on the wrong side of trying to buy bounces, and surely it can't keep going down any further than this. Ask me about my Blockbuster trade. Epic fail. I lost like $600. So I thought surely somebody would come and say Blockbuster. I made the same mistake with Circuit City. Now I've got tickers in the dog pound with a Q on the tail end of it, meaning it has no shareholder value. If you've ever made that mistake like I did years ago, you learn the hard way. Trends are indeed your friend as long as you're going in trend, right? Trying to outguess the trend and buy on the cheap kind of department store mentality. It's going down, it's going to bounce, is a recipe for failure. You just want to buy strength. You want to buy high, sell higher. That's what you want to do as a trader. Yeah, Kelly, I do look at the trend of the instrument on the daily. I don't have time to pull up the dailies today, but yeah, I give preference to those that are 90-day highs with a tall green candle on the right side of the chart on the daily chart analysis. And I cover that in my other courses. But yeah, that's important. A good question from Jim. How do you protect your profits from a gap down past your stop out? I'll give it half an hour or so on the open to see if it comes back to life. Sometimes it will, sometimes it doesn't. The way that I protect against gaps against me is don't hold into earnings releases. I learned that the hard way. But the other thing is start the trades off small so that you're only in, say, 20, 30, 40, 50 shares, not 1,000 shares, and it gaps against you and wipes out a big chunk of your capital. But the best that I found for, say, something gaps against you, let's say it gaps up, or let's say you're in it long and then it gaps down the next day down here somewhere. I'll wait till, say, 10 o'clock, 10:15 and see what price action's doing. And if it starts to find support within that first half hour of the market, sometimes it will, then I'll hold it long and sometimes it'll recover. But usually a gap down against you is just, part of doing business. So that's the protection, is trade smaller size on all your positions. Smart questions. Let me know if any others. Let's see. Question from Bob, what's my stop? I use a 2-point stop, or the total drop dead stop would be a loss of 2-day support. Okay, so for example, and not for gap continuations, but for trend continuations. So for example, this is let's say I got in on the pivot, or I got in on the breakout, a loss of an aggregate 2-day support. Just underneath that would be the trend reversal place that I would close out any remainder of a trade on a stop. But the main thing is 2 points I found 2 points works well. So for example, in interactive gaming, makers of fine slot machines, IGT, it ran from 26 to just under 27. Had I bought this long here, my maximum stop would be if it lost an aggregate 2 days low support. Okay, 2 days is a reversal of trend. And on a daily chart, you'll often find a bearish engulfing or a shooting star accompanying said reversal, and that's another technical reason to vacate the trade. To lock in a profit on these things, it's another good rule of thumb. Again, 2 day. Let's say you bought this. Let's say you bought Blackstone and you're long and you're happy. You're up a few $100 in the trade. I would sell it all though if it got under, say, 30 and a quarter, under 30 at the most, right? So if I bought, say, 28 and a half, 29, I'd sell it back if it got under 30 because that's a 2 day low. Because 2 day lows usually continue down more days low. I found the hard way. So usually a 2 day low trailing stop is a good reason to vacate the trade. You know, it's always about when in doubt, get out, play the field. It's all about the math. Successful trading, as I mentioned at Money Show years ago, is much more about the math than it is the chart patterns. Because the chart patterns aren't always going to do what you think they're going to do. So what you got to do is control for that by using a very careful risk management strategy. Using tight, well-defined exits, like a loss of 2 days of price action, is a great reason to get out of a swing trade. That's what I use. Or if you're in the money in a trade, you want to build the trade by adding or scaling or position sizing every couple of points or so. And that's another sensible reason to scale in or add to a trade. I know, Kelly, I haven't used that tool. Hey, sure thing, Ingrid. Say nice, thanks. Hey, appreciate it. All right, well, I guess we're about out of time. Let me know if any other questions. If not, let's see. I have nothing to pitch. You guys can find me. I run Day Trading University, and Trade Mastery is the new branded company. I want you to start thinking as kind of we wrap up today. Figure out which entry patterns. Hopefully I've got you keen on the idea of buying gap continuations maybe a couple of days after the gap, so you give it a day or two to settle out and figure out what they want to do. If they keep buying it up after the gap, you might want to jump on board. Figure out your stops, like 2 points. It's profit targets, usually 50% of a 15-day chart from a price projection trigger point. Exit signals, when to get in and out, step-by-step entries, and a personal learning plan that helps take you to where you want to be. So anyway, I am Ken Calhoun, TradeMastery.com. Certainly welcome to check out what I've got to offer, and I wanted to thank the team at TradeStation for having me here. It's been great working with them. A really good charting platform, and for any of my traders that are considering charting software, TradeStation, and also good brokerage too. They got really good commissions too. So another good reason to consider TradeStation as something for your trading chart software needs. But great charts, right? Always look for outlier charts. Be the trader that trades strength, that trades the outlier. By the way, if you have to ask, kind of like at playing poker, if you wonder who the fish is, you got to look in the mirror, right? If you got to ask about the chart, if it's really an outlier strong chart, just say no. Stop the madness. There's got to be a better way. Instead, I look at my money like soldiers. I put it out there in the charts, and I want to come back with more than I sent out, right? Just like Mr. Wonderful. Well, what I like to do is I like to trade strength. And so, yeah, this may pull back 50%, grind around the rest of this week. I'm in it for the long haul. Maybe next Monday or Tuesday, this thing breaks out to new highs, and then I'll be all over it, right? So give yourself plenty of ample room to practice and get these things right. And wanted to thank y'all for being here. So thanks so much to the team at TradeStation. We're going to call it a wrap today. Thanks, Don, and all of you. Swing trading that opens your eyes to the possibilities of some of the stronger charts out there that make sense to trade versus the cheap charts, the expensive over $100 charts. I like $20, $30, $40 charts. Those tend to have the best sustainable trends, unlike the cheap charts, so it's easier to trade and better leverage. So anyway, thanks so much for being here. I appreciate it. You guys have been amazing. I want to thank you all for your smart questions. We got a lot of smart questions today, so that makes it worthwhile for me. And thanks to Don and the whole TradeStation team. It's been an honor, and I wanted to thank you for having me.
Ken, thank you very much for your time with us today. We hope it's been profitable for everyone. The last hour has just zipped right past with all of Ken's tips. If Trade Mastery can be of use to you down the road, please make sure that you take advantage of their services. This is not an offer or a solicitation by TradeStation, but certainly just a friendly reminder. My name's Don Prattle, and we will be back tomorrow morning for the morning market briefing. So if you have a half hour of time before the market opens tomorrow, join us for the morning market briefing. Have a great night, everybody. Thanks for coming.